Hi, welcome back. I'm going to talk to you about ETFs. So, what are ETFs? Let's get into it. ETFs are an exchange traded fund. It's a type of investment fund and exchange traded product. They are traded on the stock exchanges. ETFs are similar in the ways to mutual funds, except that ETFs are bought and sold throughout the day on a stock exchange, while mutual funds are bought and sold based on their price at the end of the day. So let's go to Investopedia to learn about more. I recommend going to Investopedia to learn more about stocks, trading, and investments. So a lot of people they're buying into this ETF. It's called SPY. Um, to diversify your money, it's best to find a good ETF. This is a great ETF because it follows the same path as the S&P 500. So as you can see, what's this? Let's look at the 1 month. There's the from July it was only 300 now. So you put 1,000 there, and you could have 2,000 back. So so what's different about ETF versus mutual fund is that ETF, it's throughout the day. You can see the price goes up and down throughout the day, and it's based on multiple stocks, like 50 to 60 stocks in that ETF. ETF shares fluctuate all through the day. ETFs bought and sold, different from mutual funds that's only traded once a day after the market closes. And it contains all investments, including stocks, commodities, bonds, offer some U.S. holdings as well as any other international holdings if you're doing international ETFs. Low expense ratios, Fidelity, the one I choose, brokerage I choose, you know, it's better sometimes than buying individual stocks individually with the less risk. So I'll just show you one of the ETFs that I feel like could double in the next few years. Everybody knows about ARK Investment ETF. ARK Invest, they got famous because of Kathy Woods. She's the one who invested heavily in Tesla, and then people now they see the fruits of her ETFs, of her mutual funds, and then they're investing in it. So just to show you, I believe that this is called ARKF. So ARKF is an actively managed exchange traded fund, seeks long-term growth on capital, investment objects, investing in normal circumstances, primarily at least 80% of its assets domestic foreign securities companies that are engaged in Fidelity's fund investment themes of financial technology, fintech, innovation. So everybody knows that fintech is, it's going to be big. Everybody's going to use their phones and to use and purchase items. And I do believe that fintech is going to be bigger and keeps getting bigger in the next 5 to 10 years. You know, you can. What's good about ETFs is there's, you know, just like a mutual fund, 35 to 55 holdings, and the market cap for this ETF is 231 billion. And she's a portfolio manager, Catherine Wood. Net assets about $1.96 billion. So she put a lot of money in this ETF, and you can see the chart from 1 year ago. And this ETF, most of our ARK ETFs, they just exploded. So even this one, $20 last year. Just keeps on rising all the way to $63 and then it's dropping off. Because most of her investments are speculative. Um, she looks for disruptive technology, which she finds disruptive. And let's see the top 10 holdings in this. So Square, Silvergate, Zillow, PayPal, C, Pinterest, Shopify, Tencent, International Exchange. That's IDN. These are the market prices, and these are the shares held in that ETF. So she has 1.8 million, 1.85 and 55,365 in that shares held, which is mostly her ETF. This ETF is mostly based upon. So she have almost close to $438 million in Square. So if Square does well, this ETF, and everybody knows Square, this stock was about $60 last year. Now it's exploded to $200, $236. So she knows what she's doing. She bought it for a little bit low, he'll hold it, and now it's almost that much. And what's another one? Pinterest. Pinterest. Most of these are from last year. They were already low. She bought really low, and now they just exploded. So I do believe that ARKF is an ETF you have to look for, and this is a good ETF to buy and hold maybe for the next 5 to 10 years. Could be at least, I don't know how much, but it will be increased in over the next 5 to 10 years. So let's get into the two ticker symbols that I believe could 2 to 3x in the next few coming weeks. Let's see. This first ticker symbol is called Pong or Atari SA. So the last few videos I talked about this new software program that I'm using is called White Charts. Still using the free trial version, but I'm just looking at the stock, and from a fundamental standpoint, just look at the key stats. Revenue, trailing 10 months, they've accumulated about 23 million. Revenue, percentage growth, 18% and year over year. Diluted EPS, which is earnings per share. Measures total net income divided by the average number of shares. Not that good. Negative 23%. Net income, trailing 2 months, not even close to a million. But as you can see, the profitability growth is about 87%. That's high profitability growth margin, and profit margin 30%. So, and they also have the backing from they have limited brand NFT. So NFTs are non-fungible tradable assets. But let's look at their website just to go back and show you the wonderful world of Atari, which I do believe is a good stock. Okay, not much. Let's see what's anything new, news and updates. So the newest news. Let's see anything new. Actually, this is the newest news. Partners with to bring Shaun the Sheep hit mobile game Roller Coasters Tycoon. So it's updating the games. But the one interesting thing, I think, Atari Casino. This is what I I think will drive their share price way up. Atari Casino, which you can play online gaming, and as we know, online casinos or they're major right now with DraftKings and uh, Golden Nugget. This is what gonna drive the share price to $5 to $10. Um, they go to the casino space. There's the massive opportunities. You know, they're thinking about building actual hotels too, Atari hotels, which I think that would be interesting to do. Lot casino, a lot of games, licensing, casino, a lot of games, real money. Uh, you know, these are just information about their Atari Casino and Casino Atari. Okay, I just try to find this website. Okay, they're still building the website. I'll just try to look for it. It's coming soon. But let's see, Atari investors. I just want to show you the most detail from this video. And these are international stuff, but okay. Next thing of a symbol I will talk to you about is Academy Sports and Outdoors. Oh my gosh, this stock exploded after earnings report. As you can see from the ticker symbol, $24. It was in March 29th. Now 7 days after, it hit a high of 30, $33. I still feel like I have 630 shares. I do feel like this tinker symbol can just go up to $60. Since there's another company called CT Trends. Um, CT Trends. That's ticker symbol is you know this ticker symbol is about $89. And even their valuation, they're evaluating this company up to $200, which I think is kind of interesting because we actually Academy has more better profit margins. Actually, they have good profit margins too, but see we have more revenue actually. Okay, let's see the revenue. Trailing 12 months, $5 billion. Check mark. Year over year growth, 39%, and diluted quarterly year over year growth, 166 and 166% growth year over year. Net income trailing 12 months, $336 million. So this net income is calculated by, you can click on this, is the total amount of profit earned in a company. This metrics will all down to the overall profit that left over from the revenue that company receives after taking out various optional lines items such as cost of goods sold, income tax, income tax expense, SG&A expense, etc. So this is the actual profit they are making after everything else. So they made about net income about $336 and 52 $336 million and 52,000. So gross profit, they're profitable 31%, and they don't have a dividend, so that's not they don't have it because they're still IPO'd about back in October. So 1, 2, 3, 4, 5, 6. Think about the end of the year, it'll probably be $50 to $60 in stock. And let's see their finances. White chart is beautiful, and you can see all the finances back in. Well, they don't have all the way to the last 5 years, but this is an old company. They've been out since the 19. Let's see, since 1938. So it's a very old company, and you can see their net income from. Let's see. You could change it right here. You could change it from annually, so you can see the last 4 years. Net income. So net income exploded from 120 million last year, from to now, which is 200. I mean, 100 and no 308 million, which is a 200 million increase. And let's see. Okay, so that's a check mark. And EBITDA. I don't look at EBITDA. Um, Look at their balance sheet. Look at their. These are all assets. Cash, accounts receivable, inventory. These are all assets. So you can see land, property, machine. These are all assets that they have. So with all these assets, they have about $4 billion in assets, totaling all of their stores. They have 200 something stores. Assets over liabilities, check mark. You just want to see if they have more assets that they can over their what they're liable for, payable, current debt, and everything. And what a lot of people concerned about, they have high debt, but actually they since they have high net income, they're able to pay off their debts. So they had actually they decreased their debt from 97 million to 84 million. It's a good decrease. And this is let's see, current debt and capital lease obligations, current liabilities. See, they're decreasing their liabilities, and total liabilities decreased. So cash flow. So net income, check mark. Woo! See that check mark right there. 217 million. Investing money, and they're not investing that much. Ending cash. Now this is so this is their, what's this ending cash? Okay, this is their cash flow. So this is cash flow, and this is the ending cash. So they ended up. Let me show you quarterly. Change the ending. Ending cash. You have to look at the ending cash. Yeah, annually. So annually they ended up with a lot of cash flow left over, 377 million left over from the previous year. They have that's a big spike. So their growth, they have a steady growth from the last 4 years. It could be from the pandemic. People are using, going outdoors more with camping gear or something. But this is a big increase, and they had debt. But let's see the issuance of stock. So they issued stock last year. Um, Shares outstanding. I'm gonna see the shares outstanding. So the more shares they offer, the less you have because since they're giving it back, they have less money to give back to the shareholders. They can dilute it. They diluted it once, but now after that, they are opening the shares. Now you're able to purchase shares. Um, let's see. See annual. Let's see the annual dilution. Well, yeah, shareholders equity. Oh, since they're young, they don't have that much information on the shares. Shares. So just to show you a company that's comparable to, um, I do believe CD Trends could be like Academy. So I do feel like Academy can reach this level, $89. So let's look at this stock. CD Trends, to show you their stock. They're a website in which people of they gear towards hip young culture with fans, fancy clothes, stuff like that. You know, but they're relatively cheap. So this clothes from Alibaba or something. I don't know, but they sell these clothes and they're really cheap and they gear towards the streetwear, something like that. But if you could see the 1 year chart, they were at low of $10. Now they shoot all the way up to $90 almost, and they had a fundamental score of 7. Valuation they're under. It could be evaluated according to Y charts up to $200, which is I do believe that Academy where it's at right now, right here, about $34, 30, 32, 31, shoot up all the way to 50s, and the revenue growth. Um, they Academy had more revenue. $5 billion versus the other one is. And they have 90%. We had 31% year-over-year growth. Profit margin, they had higher profit margins. Net income, we had better net income. So, and they're actually closing stores too. So I do believe that we're gonna massively increase in the next few years. Uh, you know, operation revenue, they're increasing. So let's see the revenues. Net income, actually they're not, they're okay. You have to look at this last 4 years. So they increased in net income last year. Diluted shares outstanding. They're increasing shares outstanding, so that's good. Let's see what else. Balance sheet. Total assets 494 million over total liabilities 330 million. It's good. And let's see cash flow. So this goes from January 2020 to January 2011. So about a 9-year difference. And let's see net income. The net income's actually decreased, but the share value is like, I don't know why they evaluate it so high. Uh, We just see that's what you have to figure out, why they're valuing this company so high. And even though they had net income, like before they had net incomes in negatives in 11, and then they increased 8 million, 15 million, 13 million, 14. There's a decrease for this year. So you have to understand why. Why is that? Ending cash, they're decreasing ending cash. Yeah, it's interesting though. This company it's hard to figure out why is there they have high valuation, and why is their stock increase so much from $10 to even $89. I'm not sure why. So you can tell me why they're increased so much, and their PE is super high, and the PE ratio is calculated through price to earning ratio, calculated by the stock price divided by EPS, earnings per share, in the trailing 12 months. So somebody can tell me why CD Trends is evaluated so high, and why is this stock price so high? Thank you for letting me know. So that's the end of my video. Thank you.